Hey guys, hope everybody's well. Today is January 17th. It's about 10:45 in the morning Pacific time. Hope you guys are doing well. One of the companies that has been a big change for me from 2023 to 2024, and they've been working on this change for quite a bit of time, is Nutanix. As you know, I have a deep technical background as a chief technology officer for about 20, 30 years as well. So I tend to focus on a lot of the tech companies that have technology and that have good customer adoption as well. And one of the key things that Nutanix has done is in the space of what they call hyper-converged infrastructure, HCI. They've actually done a very amazing transition from being a primarily appliance and hardware, mostly hardware company, to a software and a software as a service company. That transition has taken a few years. The company was started quite a while ago, about 2005, 2009, sorry. And since then, for the last 14 years, has been on the path. They went public in 2016. So they've been public for quite a bit as well. But dramatic slow growth in the middle kind of messed them up. And the last 2 years, they've done a very good job of turning that ship around to more of a software as a service recurring revenue model. So I wanted to give you a little bit of a feel for what the company does, what the company is, why I'm excited about this for the long term. So let's dive into it. If you look at the data center, and this is where Nutanix and a few other players play as well, the data center essentially comprises of infrastructure that is specifically siloed. It's very vertical. So for example, if you want to buy compute, that's a specific set of racks. You can only host compute there, Dell servers, things of that nature. And then the same company, Dell, might sell you storage units that is also completely separate. It tends to be different from EMC, one of the companies that Dell bought, sells storage, and they keep that separate on NetApp. Then network, you have to go to Cisco or Juniper or Arista Networks. So all of these traditional silos still exist, and that is nearly 80, 90% of most data centers. The good thing is they're isolated, but the challenges of this traditional infrastructure is you need four teams of people. First, you need a team of person just to manage compute versus storage versus networking. Then you need to be able to manage virtualization across all of these units. So there's a lot of people that are involved, and each of these silos in terms of teams don't necessarily talk easily with one another. There's a lot of specific expertise in one. So converged infrastructure is the ability to be able to replace all of those units and actually put them in one. It's an appliance that can serve as storage depending on how much you want versus compute versus networking, but everything in one. And you move this more into a software-defined compute and infrastructure and storage as opposed to only being hardware-defined with some software on the top. So that's the big change. And hyperconverged essentially takes this to the next level and makes it a lot more easier to be able to manage all of these in one place. And this is what a lot of data centers in very large companies, whether it's financial services and retail, or even the hypercloud companies such as Amazon, Microsoft Azure, and Google Cloud are also adopting. They've not adopted it 100%, but a lot of them do their own work to a large extent. But this also accelerates a lot more as data centers start to dramatically change over the next 10 years because of AI. So that's one of the big things that you want to be able to understand first. This is what hyper-converged infrastructure is in the data center. The data center market is large. It's a significantly large $1 trillion market or more. And within that, if you look at the ability to be able to take infrastructure that exists and move that more of a converged format, not 100% of them will move, but a lot of them would benefit from the software-defined market. And the hyper-converged market, depending on who you talk to, some people say it's about $38 billion by 2027, moving literally at about a 30% cumulative annual growth rate. And some people say it's about 76 billion if you look at all of the elements of the conversion infrastructure plus all the software and the services and the consulting that needs to be going with it. So global hyper-converged infrastructure market is the one that Nutanix operates in. VMware is another important player. They are the market leaders in that market. And the CEO of Nutanix is from VMware. The addressable market for Nutanix specifically goes from again, this is Nutanix's view of the market versus that was more of an independent view. They're claiming nearly twice that amount, 76 billion. Now, the move will come primarily from a lot of so what do we mean by on-prem is a lot of companies, the big ones especially, had built out their own data centers over the decades and years. And only in the last 15 years or so, more specifically in the last 10 years, they've been moving some of their or all of their infrastructure to the cloud providers, whether it's Amazon or it's Google or it's Microsoft Azure. So there's a lot of stuff that still exists on their premises, which is what on-prem is. So the hyper-converged on-prem infrastructure needs to also move from the converged one that it is right now. That's the biggest opportunity according to Nutanix. That's nearly half the opportunity. And then the hybrid cloud infrastructure essentially is you're using some of it as on-prem, some of it is cloud. What is it that you need to be able to seamlessly manage both of these on-premises and on the cloud? And in some cases, cloud management is when you have multiple clouds, when you have a little bit of Google for maybe your data analytics and big table, then you might have a little bit of Amazon for compute, or you might have a little bit of Azure for specifically AI, et cetera. So that becomes very difficult to be able to manage multi-cloud, and hyperconverged infrastructure helps with that as well. And of course, databases and systems. So their claim, this is Nutanix's claim. This one, as you saw before, 38 billion by 2027 is the hyperconverged market according to industry analysts. And this is what Nutanix themselves claims, about 36 billion. 76 billion, excuse me. And then depending on who you talk to, this has gone already from about roughly the 15 billion to about 30 billion. This deceleration already happened, but now it's starting to accelerate again. It's very concentrated. VMware, Nutanix, Citrix were the three major players, but now there is a whole host of players. Cisco does a lot of work, Dell does a lot of work, and then Hewlett Packard Enterprise just last week bought Juniper. They're also a big player in the market. The hyperconverged infrastructure market is large in North America. They usually tend to lead. Europe follows. And Asia is third. They just tend to take a lot of time. So Nutanix, for the longest time, sold you an appliance. They sold you a physical piece of hardware on top of which they built their own operating system, Nutanix operating system, and then sold it. But now they're taking that software component and they're also selling it on top of Dell infrastructure, HP infrastructure, and some of the other infrastructure, which makes them more of a software player with higher margins and higher growth, because previously they were in the single digit growth. Now they've gone to a double digit, 15% to 20% growth. So that's a very good sign as to why Nutanix is doing very well. The big market for them is still in the data center. And there are other applications as well, disaster recovery, backup, etc. But still, virtualizing applications, data center tends to be the most important markets for companies in the hypercloud infrastructure space. VMware is still the market leader, as I had mentioned. They have nearly 45% of the market. Nutanix is number two at 18%, but that gap is narrowing. Nutanix has narrowed the gap in 20. This was in 2020. The data they came was from 2018. There's no other new data that is available. But if you look at the revenue from vSAN for VMware storage year, not necessarily storage networks, but this is essentially software and application-defined networking. They actually are down to about 41%, and Nutanix is close to 21%. Dell, Cisco, Microsoft, they all play in the hyper-converged infrastructure space, but it's VMware and Nutanix, their goal and their market to be able to lose. Then VMware, if you remember, Dell sold VMware to Broadcom. The ticker symbol is AVGO. So VMware now, because of the acquisition, is going to take a while to be able to consolidate, but Broadcom is an extremely good operator. They're probably going to optimize VMware's go-to-market pricing and also going to optimize the team. So they'll probably get more profitability from that. Not necessarily sure they're going to be able to increase the market share, but Nutanix has been taking share away from a lot of the smaller players, not necessarily from VMware, but VMware is still losing share. So as I said, VMware was founded in 2009 by three founders in the Silicon Valley. They shipped their first product in 2012, and then they introduced the hypervisor. They went IPO in 2016, as I had mentioned before. And since then, it's been a mixed bag. They did very well for the first couple of years after the IPO. Really, you'll see in the monthly chart, the stock rose dramatically. And then after a couple of years or 3 years of really poor growth or lack of growth, I should say, in the single digits, they just absolutely tanked. 2021, 2022, 2023 as well, to a certain extent, has been a building year. for them as they've transitioned from a hardware and from an appliance provider more to a software provider. And now I think they're probably ready, as good as anyone, to be able to launch and move forward. And they've launched a lot of partnerships in the last few years. In the last couple of years, they've done a very good job of turning their business around. So when you look at what Nutanix and all of these companies do, they help larger companies and mid-sized companies build the apps that they want to do, whether it's building their own custom vertical application for insurance or banking or finance, or also internal applications, and then running them, whether they be on the cloud and their own data center. So we start from the bottom. Infrastructure that is provided allows you to be able to run the Nutanix Cloud Platform. You can run this on top of your own data center appliances, such as the ones that you might buy from Dell or from others, HPE, or you can run it as part of Google, Microsoft, and AWS. And this seamless nature of the OS platform allows you to be able to manage resources without a challenge at all. And then on top of that, what allows you to be able to do is actually manage the platform services more effectively. So what you want to do is abstract away a software component, software-defined component, very similar to what, for example, VMware did back many decades ago. You have multiple servers. Instead of having to manage all of them individually, you can create a layer, virtualization layer, that allows you to be able to create different applications run within a portion of the infrastructure. This one allows you to be able to manage it across all of your servers and systems. So in some way, it does compete with, as I said, VMware. So what they allow you to be able to do, Nutanix, is you get one single platform. You can manage your data, you can manage your applications, whether it's on the cloud, whether it's on the premises. You can use any servers that you want from HPE, from Dell, from other companies as well. IBM, for example, through the Red Hat partnership, or through any hypervisor, whether it's VMware or Microsoft. Those are the two most important hypervisors right now. Hypervisor essentially is a software system that allows you to be able to abstract the operating system specifically that you run below it, and even the hardware below it. And you can run it across any cloud. So whether it's Google, AWS, or Microsoft Azure. So although they say this is a little bit funny because they say it's a consumer-like experience to manage data center, it's not that. You can't just go open an app like you do on your iPhone and just manage and click through the whole thing. They're trying to get there. They will never get there in terms of consumer-like experience to manage a data center, but it's easier than before, where it was a lot more complicated with vertical silos that don't talk to each other. They have strong customer satisfaction ratings. Their customers, and that is reflected also in their renewal rates. Their net promoter score is over 190, and their renewal rates are close to about 100, 115. So their customers end up spending more money with them every year. And because of the fact that you're converging infrastructure, it lowers your total cost. So what does the Nutanix platform do? It can run on top of any infrastructure, it can run on top of any cloud, and it can run on top of any hypervisor, as I said. And you can manage both your cloud systems, and you can manage your infrastructure with a unified storage, unified system, and then you can run your applications on top of the Nutanix Cloud. Allows you, they sit like a layer. Think of them like a layer on top of these that allows you to manage everything at the bottom seamlessly, and then run applications on top, so you don't have to worry about whether it's on-prem, whether it's on the cloud, any of those things. So this is a simple Marketecture diagram that shows you exactly where Nutanix fits in. What are the use cases? So what do customers use it for? CIOs and a lot of infrastructure, VPs of infrastructure within the IT organizations, if they want to be able to move their application from on-premises to the cloud, or from one cloud to the other cloud, instead of having to then rewrite portions of it or re-platform portions of it, they can just take it, which is running on top of Nutanix Cloud, and then move it to another Nutanix Cloud on Azure, work seamlessly. Another one is disaster recovery. Again, what you want to do is, if something happens to the data center that you're running it on, seamlessly you want to be able to move it. You can literally create a replica, move it into Azure, move it into with your own cloud infrastructure. You don't have to worry about the underlying components as well. And then what happens typically also is, this happens very much in retail. Retail tends to get a Q4 big push in terms of customers. Black Friday, Cyber Monday, you get a lot more customers during that time. So you get bursty traffic. So only during the bursty traffic, you want to move to the cloud. You don't want to re-engineer something completely separately on the cloud. You want to have your same application, and then when the time comes during retail Q4, you want to be able to move a certain portion, or maybe just move it to the cloud during those 3 months, do an effective job of managing infrastructure without having to pay for it for 12 months, only pay for the 3 months that you use excess for, and then move back into your location, or even for geographic expansion. So you have a big data center in the US. It doesn't seem to work very fast when customers are accessing applications from Europe. You can just replicate your infrastructure over across to the Europe cloud if you want to. Within AI, this has been a very, very big move for a lot of companies. AI has been the tailwind, has been the wind behind their backs, right? And what allows you, what Nutanix does is they're saying, don't worry about the infrastructure underlying at the bottom, although that's easy to say, but Nutanix, more than everybody else, is also claiming that they can allow you to be able to get GPT in a box with generative applications. They have put their own infrastructure and provided you with a reference architecture. That's what on the right-hand side, you can see the unified storage, the machine learning operations, and the Kubernetes flow built on top of PyTorch, which is a library on top of Python, and then gives you the ability to manage through the foundation models as well. This is not what I've heard a lot of CIOs, not a lot. I've talked about 2, 3 people that are actually using it. That's not what they're using it for right now. Right now, they're still in the trying to make sure that they can move their old on-prem data center applications to the cloud, move it and make it seamless. This is what they want to do, what they would like you to be able to do. Be the layer so that you don't have to manage the underlying. Okay, so the core platform that they provide, the core hyper-converged infrastructure, virtual desktop. So think of it like you have a big server, you split it into multiple virtual machines, and each of them can used by different customer service rep. Customer service rep don't quite need a very high-end, high top-of-the-line kind of computer, so you can buy a very big one and then split it amongst 4 or 5 people. The virtual desktop gives you the ability for each of them to manage it within their business applications on top of it. And then I don't necessarily look at this as something which is top-down private clouds. This is more of a percentage of money being spent on various different elements for cloud. And IT infrastructure, as you can imagine, is one of the biggest. Most companies use infrastructure as a service, IaaS, although SaaS is a much bigger amount of money being spent. So the claim is that Nutanix can address both infrastructure and SaaS apps, as opposed to VDI, which is where VMware and Microsoft tend to dominate. So one of the big things I had mentioned to you was, number one, they've done a transition. They're moving from a appliance hardware sales company to more of a software company, software as a service subscription go-to-market motion, number one. Number two, the other big thing that is working for them is the move towards AI is helping people realize that some portion of their applications they want to build generative AI applications need to work both on the cloud and on-prem. So how do you deal with that? That's another good thing to worry about as well. And the third one, more than anything else, is when you move to the subscription kind of a model, their go-to-market partnership model becomes a lot more important than just hiring a lot of salespeople. So they're moving to an annual contract value. So it improves, so margins improve much better than hardware margins in the 60%. This is 80%. They get a lot more productivity by using and selling through partners as opposed to selling themselves alone all the time. And then they're retooling how they go to market as well. They have a lot of partners from a data protection side all the way to applications, cloud providers. There are over 750 different partners on any hypervisor that you can run it on. Most of them probably run it just on VMware and Microsoft. But they have and of course you can do it with Citrix as well. You have a lot of different partners across the place. And what you're trying to do is to make sure that all of these either apps run on top or the infrastructure gets managed through. So this is a tough move for a platform company, which is relatively small. Speaking in relative terms, Nutanix is not a very big company. They're doing about $2 billion or a little less than $2 billion in revenue. That's small among the players that they're playing with. So they're growing their partner ecosystem, whether it's the hardware providers like Cisco, Dell, Hewlett-Packard, Lenovo, etc., or the cloud providers, Microsoft Azure and AWS. They also partner with Google Cloud. And then they sell through channel partners for the mid-sized companies. Most mid-sized, mid-market companies don't buy directly from Nutanix. They buy through a channel partner. And they have ISV partners as well who build on top of that. So it becomes easy on Nutanix operating system. So it becomes easy for them to be able to manage it. As I said, they're moving roughly in the little less than $2 billion annual recurring revenue right now, or 1.4, I think. Although their total revenue is about 2 billion, little less than 2 billion. They're driving towards 3 billion by 2027. So that'll be about nearly a 50% move from here, 2023 to 2027, roughly a 50% jump up, 20% CAGR. They're not they're not perfectly profitable. They've had free cash flow, but they're not profitable in the real sense, net income wise. And their stock-based compensation is 14%, really high. Good for the employees, but really high. That's what they're trying to be able to guideline towards. They have about 25,000 customers. They added about 500 customers in Q3 2023, which was the calendar year, but fiscal year for them is 2024. Very high retention rate of 123%. What that means is essentially people are buying more. So when a customer comes in, they bought $1 worth, now they're buying $1.23 worth. Um, they have about 1,050% of the global 2,000 of their customers, and they've expanded fairly well. Across all of the workloads which I had mentioned, whether it's virtual desktop applications, infrastructure, they are seeing growth in terms of the addressable space, which is why they're claiming that their market is close to about a $76 billion market. When they reported their earnings last quarter, um, across the board, very strong movement. You look at 24% billings growth. Recurring revenue has gone to about 1.66 billion, as I said, less than 2 billion, and that they expect to go to 3 billion. So that's almost double from 2024 to 2027, so about 3 years. 18% growth on revenue to $500 million. Gross margins are 85%, really strong compared to where they were before. Their long-term focus is about 80% range. So this is software margins, very strong software margins. Don't have good net margins yet, but they're working towards it. And for the first time in a long time, they've actually gone to free cash flow. Good recurring revenue, 1.66 billion, about 219 customers with doing more than $1 million in annual recurring revenue. So think of this company more like a software company and less like a hardware company is another big change. So moving from hardware to a software-defined company, moving more to an annual subscription revenue company, much higher margins, partner-defined, go-to-market. That's the way to think about that. They've grown their customer base slowly, albeit they're still growing it. And the annual recurring revenue has gone from about $1 billion in the last 2 years to about 1.6 billion. So just a summary: 1.6 billion, 66 billion annual recurring revenue. This is annualized, not on the quarter. Roughly about 25,000 customers. Adoption is very strong. They've got good flash flow, not yet very strong on operating income, but I think they'll get there. That's Nutanix in a nutshell, just to give you a little bit of a better sense. Okay, now that we've done that, let's now focus on looking at what Nutanix really is from a stock perspective. Let's look at what's going very well for them, what's not going very well for them. Let's do our 5-step analysis. Might take a little bit more time than usual, but we're going to do it right. Okay, okay, let's go to the monthly, and then now we're going to go to the fundamentals. Nutanix, um, since its founding, has gone through a couple of CEOs. The founders initially ran the company, and then Rajiv, who's from VMware, has been the CEO of the company for the last few years. Okay, annualized revenue has gone from roughly the 800 million, almost doubled, more than doubled, to the 1.8 billion. Look at this. This was great growth before, and then just dramatically slowed down to single digits for 3 years, 2018 to 2019 to 2022, and then has been starting to pick up back again to the teens. So this is a good sign. Now look at this. This was about 40% gross margins. This is about 84% gross margins. That's the big difference. Notice that. Still not making money. You look at the net income for the last year was not great, but they're turning that around. Look at this. So this was losing $1 billion, losing 800 million, losing $1 billion, and then this is slowing down dramatically in terms of their ability to lose money. So very, very good movement there. We look at it quarterly for the first time, as they mentioned, they're actually trying to turn a profit. Net income is still not profitable for the quarterly basis, but getting there. Free cash flow is one step to get there. $500 million last quarter, 84% gross margins. Most of the money that they're losing is probably because of sales and marketing expenses, because operating income is literally 10 million on a gross profit of 400 million. That is ridiculous. They should get to the 20% range at least. So looks good from a growth perspective. They're back now. It's 28% versus 18%. So still slowing down a little bit. I hope this doesn't go like this and then slows down again, but they seem to be saying they were going to be in the right direction. From a balance sheet perspective, they have probably about 1.7 billion in cash and near-term assets, total debt about $1 billion. So they should be able to service it as long as their cash flow is okay. So they seem to be cash flow positive. Again, from a negative 20 million a few quarters ago to now getting to the point of being cash flow positive is a very good sign for Nutanix. Okay, let's look at the valuations. They obviously don't have any earnings to speak of, so no PE. This is the big challenge. So they've gone from a, not challenge, but that's what's happened because of their high margins. They've gone from a 2x price to sales to a 6.7x. For someone growing at a teen, 6.7x. I've given up on trying to get my idea of valuations being in line, but you can't really to understand why the valuation expansion, multiple expansion has happened unless you understand they've moved to an ACV model, annual contract value, subscription-based model, 84% gross margin. So all that is a good sign. They've gone, if you look at this, let's look at it from an annualized basis, just to give you a little bit of context. Look at the 60% gross margins to 80%, as I mentioned, 84% gross margins annualized. Very, very good. Negative 40% to negative 3% should get to the 20%. I think they will get there. That would be the goal at least. So that's the fundamentals. On a scale of 1 to 10, I would give this growth of 17%. Multiples are okay, so about 7. Good move, but obviously not perfect. Okay, so they went IPO 2016. This was a stage 1 consolidation, stage 3 consolidation, stage 4 breakdown, and then a very good move up. This was all the way to 2018. Really strong move up. And then revenue just slowed. They took a 4. This is a markdown, strong markdown. Tried to make a move up back again. Stage 1, stage 4. And so this has just been a seesaw. It's like a roller coaster, up and down, up and down. So you have to know that's the personality of the stock, but that's because of the inconsistent growth. But over the last, let's say, May of 23, they've done a good job of being in an uptrend. Not a perfect candle, but not a perfect trend, but this is the uptrend. This is a stage 1 consolidation accumulation, and this is a stage 2 markup phase. Because they're still in the stage 2 market phase on a monthly. So let's adjust this on the weekly phase. So this was a 52-week high at the 44 range. They've blown past that, grown really strongly after that. So if you look at this and say, okay, this is where that channel looks. This is how the channel looks. If you have to move it down a little bit, this is very, very nicely outside the channel. So they've done a very good job. This is a multi-year high, actually. Yeah. So 44 was a multi-year high, not a 52-week high. They're still at a 52-week high. That's true, just by looking at it, but even in a multi-year high at the 52, 51 range. So very strong movement in the last few weeks. This is one interesting thing. Look at this. This is a left shoulder, head, right shoulder going down. Right now, it's been doing nothing but just go straight up. I think they're very confident that they'll get to the revenue range that they want to be able to get to. So if you had to do on a shorter term time frame, this is the new channel. This was the new channel. I'm going to remove that. This is the new channel. Really steep in the last few weeks. It's consolidating this day to today, maybe even not today, even today, but it's been hitting 52-week highs and just moving up and to the right. The next big resistance, so support for it should come technically in the 48 range. So this should be a support area, and the resistance for it, let's go a little ways back to see where the next resistance might be. The next resistance should be somewhere over here in the 54. There's a little bit of resistance in 54, but realistically what they're going for is the 65 zone. That's where it'll get to an all-time high, whether it gets it next year, this year, because a lot of the analysts, one of the things I wanted to show you guys is the forecast for the stock. Among the analysts, lots of people very, very bullish on the stock overall. There are 14 analysts who are tracking Nutanix. 10 of them have a strong buy. Nobody has a sell. Everybody has either a buy or a hold. And the reason is because the stock has just gone up dramatically. There's a little bit more downside on the stock is what they're claiming, down to about 42. But that's because valuation is just, as I've shown you, it's gone from 3s to 6. It's double the valuation in the last 1 year. So the next logical point would be 54 for Nutanix. And where the market is overall, my suspicion is this is going to take a little bit of a break. Right now, this on the daily chart, just hitting the 52-week high and then trying to take a little bit of a break. This should consolidate very similar to what it did before. Consistently 52-week highs, it's been consistently hitting it very nicely, very good movement, protecting within the channel. So it should move within the channel and try to test at least the 48 mark, 47, 48 mark, and then move back up again to the 52 range, which is 52, 90, 54 range. So that's where I would play this. It's a very good stock, very strong margins. The story is the profitability that's coming. The story is the growth has gone from single digits to percentages wise. The story is it's a software story, gone to 84% gross margin. So once they tighten up the go-to-market with their partnerships and also their channel movement, they should be able to move back up again. So Nutanix is the stock, NTNX, very good moves, but remember, most of the analysts are predicting they get to 44. The moving averages are pointing all up to the right, but this is stretched from a 20-day moving average. This is the 48 range, so I would wait for it to 48 to be able to buy. On the RSI, pretty much hitting to the top of the RSI. So this is, as you can see, this is the top of the RSI. Very good move up over here. And then look at this. This is actually it's going down, so it's okay. And also a good move on the MACD. So all of these are pointing to the right. So it should move a little bit more higher, at least to 54. I would wait for a move back to the 47 or so. Although I think this is going up to 54. Not enough of a move for me to be able to take the trade, but good company. Keep this in mind. If it comes down to 48, or even if it comes down to the 44, this might be a very good buy to move back up to the 54, 60 range. Thank you for watching. Please like, share, and subscribe.